The Federal Reserve sets interest rates to hit a 2% inflation target. That target determines your mortgage, your savings rate, and the cost of every loan you have ever taken. Nobody told you the number was invented by a New Zealand central banker in 1989 and adopted without a vote. In 1989, the Reserve Bank of New Zealand became the first central bank to adopt an explicit numerical inflation target. The governor at the time, in a television interview, mentioned the figure of 0 to 2% as a rough benchmark for what price stability might look like. The number was not the product of an economic model. It was a convenient figure used to communicate a policy direction. It spread. Central banks in other countries adopted similar targets. In 2012, the Fed formalized it as an official target for the first time. It has never been voted on by any democratic body. It has never been subject to public consultation. It is the foundational parameter of American monetary policy, and it was essentially arbitrary when it was chosen. The practical consequence of this number is significant and direct. When inflation runs above 2%, the Fed raises interest rates. When it raises interest rates, your mortgage rate goes up. Your car loan gets more expensive. The cost of business borrowing increases. Economic activity slows. People lose jobs. All of this happens in service of returning inflation to a number that a New Zealand central banker mentioned casually in a television interview 37 years ago. The economists defending the 2% target have produced extensive research explaining why it is broadly correct. The number that governs the most consequential financial decisions in the global economy was never chosen through any process that resembles democratic accountability. The full story of what the Fed is doing right now and why the decisions it is making will directly affect your financial life in 2026 and 2027 is coming. Follow